market in China. This is interesting because we have mostly been working on building your minimum innovation strategy for large companies, large conglomerates, energy companies. But we also find the tool to be very applicable for startups. So that'll be the session today. Before we kick off, I just want to say hi and check in with you guys. So I'm Chris. I would love it if a few of you just to check our setup. Type in where you're tuning in from. So anybody from the US, anybody from Asia, anybody from Europe. This is just to get the first chat going. Tallinn, Estonia. I was there a couple of years ago. We have somebody from Dubai, Switzerland, Norway, Oslo, India. That's a first. So welcome, wonderful. I think I should probably tell you guys this, but you can see me, Chris, on screen. But we also have Jillian, who's in the background, and none of this would have been possible without her. Now we have people from UK, used to be Brazil, and it looks like Jamie. Hello there. All right, so let's kick this off. First of all the slides that we'll be sharing, you'll get them. The video will go on YouTube probably within an hour or a few hours. But there's also a lot of free stuff. There's a lot of tools. So some of you might be familiar with strategy tools. That's our ongoing 7-year research project. And you will find tools, some case studies, and of course some how-to guidebooks that you might find relevant. All available for free at strategytools.io. And just like we tested right now, please feel free to join the conversation. Raise your hand with a question. Chat, fire away. We'll try to cover any questions, any comments as they come along. And we'll also make sure to have a few minutes for Q&A after we wrap up. So very briefly, my name is Chris. I'm a long-time advisor on strategy, innovation, transformation. I've been fortunate enough to work with quite a lot of very interesting companies. I'm also a business school faculty and I teach same topics. And I've spent a lot of time on designing strategy tools that are today being used in large companies, small companies around the world. Primarily my day job, or our day job, me and Jillian and a few others, is we run a global strategy and innovation consulting company. And we really get a chance to meet different people, different company in very different industries and very different cultural settings. Some of you probably know I spent quite a bit of time in Malaysia recently. We do have some projects coming up probably in the Middle East. Very interesting collaboration going on in Sri Lanka. So even though we're based in Norway, we are fortunate to be working on these things in a global setting. We're also very focused on, we need to truly partner with the CEO and his strategy or transformation office. And we also spend a lot of time on helping facilitating innovation and new ventures. And that's exactly what we'll be talking about today. So very briefly, some of the projects that we've been touching on over the last 2 years is really relevant to today. So we've worked on several projects within mobility, smart cities, electric vehicle, solar energy, and I'll be using some of those as partial examples and case studies today. All right, so let's jump to the essence of this webinar: building your minimum innovation strategy. So this is a term that we came up with some months back after exploring this discussion with a lot of clients. And the starting point was really, so our clients would tell us, we want more innovation. Where do we start? What's the starting point? And what we found was that their gut reaction to the same question, so they would answer their own question with start internally, meaning we will do this ourselves, our people, our staff, will do this innovation work, which might be good, it might be true, but it's probably quite insufficient. So what you're looking at right now is the tool that we call the minimum innovation strategy. This might not be easy for all of you, but if possible, I would really suggest that you print it. Maybe you can pull it up on a second screen, maybe you can pull it up on your iPad, but it's really ideal to print it. And this is what it typically looked like in our 1 or 2 person setup. We frequently, I mean, we have stacks of these tools, right? Laying in the back here. So it's really useful to get these on paper. It's better for your thinking, it's better for your discussions later on. We also, as some of you know, frequently recommend studies. So some of you have been working with us on these. And studies, of course, much like the Post-it, just better. It sticks to any surface. And you can easily slide them around, and much easier to work with than the regular Post-its. So whether you work on this tool by yourself in a small team or a large group, you probably want to print it. You probably need some studies or Post-its, and you need a few good pens. You've been warned. All right, so brief background. The tool that we'll be discussing today, the minimum innovation strategy, really comes out of Cisco's work over the past, give or take, 10 to 12 years. Cisco is one of these big companies that we follow closely. We've also had the pleasure of working with briefly. And Cisco has really built a solid innovation engine and a solid innovation strategy. They call it the build, buy, partner strategy. Now, a couple of years ago, they expanded that and said, build, buy, partner, invest, and co-develop. So you'll see that our framework is really a replica on Cisco's groundwork, and then we're taking it a few steps further. So Cisco is really the source of this tool. Now, Cisco has put a lot of work into developing their innovation engine. And I've never met a company that has such a clear and sharp understanding of how the innovation strategy at Cisco or any other company really truly functions. I've been so impressed working with and meeting with Cisco executives on how they understand market opportunities, how they understand we need to build, buy, partner, invest, or co-develop, or many of them, and how they're able to build this machine. And I think this illustration that you're seeing now, which is from Cisco's website, is really a good overview that few companies can match. But it's not exclusive to Cisco. Cisco might be one of those companies that have really pushed it, elevated it, but other companies, including friends of ours at Mac 49, have been using the build, buy, partner framework for years when it comes to how to build good innovation strategies. So Cisco, Mac 49, and also other companies have all started working on the build, buy, partner, invest, co-develop, and that is the real-life foundation, if you will, for our tool. And you'll see that quite clearly when we get into the details. Also, just very briefly, I will be mentioning a second tool called the Industry Shifts Map. We've covered that in previous webinars, so you can find that online. But the Industry Shifts Map is really a tool to understand how the landscape around you is changing and how your company is able to respond. So we're not going to go into depth on the Industry Shift Map, but I'll be mentioning it a few times, and this is background. So let me give you an introduction to how to put this tool to work in the context of the automotive industry. So right now there's a massive shift going on around the car and the mobility industry. So the slide you're seeing here is Volkswagen's original Transform 2025 strategy slide. Now, this is extremely interesting for our conversation today. So Volkswagen has put a lot of work into understanding how the industry is changing. They look at how they, as a company, need to move from the traditional car manufacturing and into, quote, revolutionary business model innovation, where Volkswagen will be moving from the traditional car development, mostly done in-house by Volkswagen engineers, and they need to open up and build what they call ecosystem. So Volkswagen's response, and I know I'm moving quite quickly on this, Volkswagen's response to the industry changes is we need a much more aggressive innovation strategy. We need to transform our core business. We need to move from selling cars to building mobility solutions. And of course, get investors along for that story. But what's fascinating about Volkswagen, and we've been following this quite closely, is Volkswagen wants to move from becoming one of the world's largest producers of cars, hardware, factory, manufacturing, and become the world's leading company on mobility and mobility as a service by 2025, and also to develop the industry's strongest digital ecosystem. Now, of course, as soon as you introduce industry digital ecosystem, you're really moving from a more closed to a more open innovation platform. And I'll explain that in a little bit. So just keep that as a background case as we move into building your minimum innovation strategy. So the tool looks like this. I'll explain it in the case of smart mobility. So we have these industry level changes happening now around mobility with the example of Volkswagen. So let's say here that the example we want to pursue, the market opportunity we want to pursue is smart mobility. Now, smart mobility is a very, very broad term. It can be connected cars, it can be autonomous cars, it can be mobility services like Uber, Grab, and Daikin. But just call the market opportunity smart mobility. So the traditional classic response, at least that we see in a lot of companies, is okay, we'll look at that market opportunity, but we'll do it ourselves. So outside people, partners, you can basically just go away. Our staff will handle this. And we have a really strong innovation engine. Now, one example of this is actually, interestingly enough, Ford, to some degree. And it's not totally fair to Ford, but this is one example of Ford's quite radical innovation, quote, Ford, where they said, look at the new angle of the hood design, how we've shaped the curve just slightly differently, which is a revolutionary rethink of a classic car. Now, this might be revolutionary to Ford, and it might be a big design change to the traditional design of the F-150, which, by the way, is Ford's most selling truck. But that is probably not going to move the needle very much in terms of seizing the smart mobility market opportunity. I'm using this example because very often we see that when companies want to develop the innovation strategy internally, it becomes very incremental. It becomes a very more of the same, and it is not really moving the needle at all. So the next step on the build, buy, partner framework is, well, if we can't build it ourselves, if we don't have the brains and the technology and the pace, let's just go out and buy it. We'll go out and we'll do a complete M&A or a complete acquisition. And one such example, again, in the market opportunity of smart mobility is Intel. So Intel, the chip and software company, traveled to Israel, and they purchased Mobileye for 15 billion US. At the time, and still is, the biggest tech acquisition in Israel. Now, Intel has been working on this kind of technology for a number of years, but they realized they weren't able to do it quick enough. They weren't able to do it well enough, and they weren't really being the global leader. So they went out and they acquired Mobileye for 15 billion. And nothing wrong with that, but this is an example of shifting from we'll do it ourselves, we'll build it, and going out and acquiring and buying. So this is a good step. Now the third step, build by partner, is strategic partnerships. Strategic partnerships are, of course, as many of you know, quite common, and for many it's a good way to go. One example in the mobility space is the strategic partnership between Volvo and Uber. What you're seeing here is one of Volvo's nice cars fitted with Uber's LiDAR radar and also a little bit of brand design on the side. Initially, this was a perfect partnership. Volvo had the cars, Volvo had the physical platform, and Uber wanted to develop the technology, right? As they started moving, a few things happened. First of all, I think Volvo realized that Uber was innovating at a much faster, higher speed, much faster. But more importantly, Uber was really pushing this unmanned vehicle, autonomous vehicle, to market much faster than Volvo was. And what happened a few months ago was that Uber went out and basically purchased 19,000 cars. So for Volvo, that's a fantastic order. I mean, you get 19,000 cars in one order, but of course, lower margins. But the consequence, the unintended consequence for Volvo was that all of a sudden Uber was getting ready to deploy Volvo cars. Volvo became a second-tier supplier. Volvo did not any longer own the customer relationship. Volvo did not any longer own the direct rapport with the end customer that all belonged to Uber. So what Volvo was starting to realize that was this strategic partnership was not ideal moving forward because they were giving up too much for Uber. And it'll be interesting to see how this partnership plays out. So strategic partnerships can be really core to your innovation strategy, but they might also run afoul for various reasons. Now, the next build by partner co-invest is really, let's not build everything ourselves, but let's identify a range of startups. And let's not invest in one startup, but let's invest in many of them. You might want to use the word seed investment or many small investments. You want to spread the risk because you expect many of these to fail. But you want to stay close to startups innovating in this space. So right now we're tracking about 1,700 startups that are in various ways disrupting the existing automotive industry. This picture is a slide from Frost & Sullivan's most recent report. And it's quite interesting what they find in terms of massive brain power, massive capital, massive partnerships at the various stages of the automotive value chain. Connected car, electric vehicle ecosystem, aftermarket ecosystem, mobility ecosystems. There's a lot of companies happening. There's a lot of companies moving up. But of course, at this early stage, it's really hard to pick the winners. So smart innovation strategies say, okay, let's invest in many. Start small. You might want to start at $100,000, maybe $1 million. Keep it small, but then take very active roles, partner with these companies, take board seats with these companies, and as the companies develop and mature quickly, you can do follow-on investments, you can connect it back to your organization. We find that very few large organizations have good setups for investing in portfolios of startups. They might go out and visit them, they might go out and speak with them, they might do one or two, we call them big bang investments. But this idea of invest in many early is fairly new and difficult for large organizations to execute on. So the last step on the framework is this idea of co-develop. Co-develop innovation programs, co-develop accelerator programs. This basically means instead of doing the innovation project in-house, you want to find outside partners. That can be Techstars, that can be 500 startups, that can be Startup Weekend, that can be Hacks. And you want to develop accelerator programs together with them. Two examples. One of them is Airbus. Airbus, of course, being the European plane manufacturer and flying mobility company. So they recently set up a urban air mobility program in China, co-led by an American company. And this is a perfect example of co-developing accelerator programs that wouldn't maybe fit perfectly within the traditional core business unit. So in this case, Airbus is scouting not just Europe, but really the world in English and in Cantonese, Mandarin. Do you have a startup? Do you have a technology that could shape the future of air mobility? Well, join Airbus, join Hacks in Shenzhen in China, and let's explore this together. So this is an example of how large companies basically outsource a large part of their innovation efforts. And now finally, we have a similar program with Ford. So I mentioned Ford and maybe a little bit of a bad light early on, but they've also been doing these kind of co-developing accelerator programs. This example is by Techstars, a program that Ford ran in 2015, 2016, where they followed the playbook quite perfectly in terms of moving to co-developing programs. So what's happening for large companies is basically this shift. Every single company that we meet, big company, small company, energy company, technology company, food company, they're all moving from this build internally and then more towards the open innovation. Co-investing, partnering, even buying or co-developing, these are all moving towards much more open innovation structure. And very often, very often, digital is a core driver for this. So that's the overall framework. I'm going to take you into, okay, so how do we do this actually? I'm going to give you two cases. The first case is for a large company. So the user group here will be a corporate team. Probably they will have very different perspectives on innovation. A typical corporate team, at least that we meet, you have one guy who wants cost cutting. You have one guy who wants more engineering. You have one guy who really want to go out of the building and meet startups. You have one that really care about digital, but they're not aligned. Very often these various stakeholders are misaligned in their corporate innovation strategy. So I'm gonna just for simplicity, kind of repeat the same topic that we just went through. So the lens we're looking through now is a traditional car company, a traditional car manufacturing that is slowly looking towards mobility as a service, autonomous cars, etc. Now, this, of course, would be a large manufacturing company. They would probably own the whole supply chain themselves. They would be very oriented around the inflow of resources, the production process, and a traditional sales model. And of course, mobility as a service might change that quite significantly. So let's say that the market opportunity is this traditional car company is now looking towards autonomous cars, smart cities, and connected societies. These are very high-level market opportunities that are emerging, market opportunities many companies, utility companies, technology companies, oil and gas companies are looking at. So the first step, and here it's just to repeat that, it might be very useful to have this handy. So the first step is this idea of industry shift, an industry shift outlook. On a 1 to 10 scale, how much do we feel that our industry will change in the coming 5 years? So if you answer at 10, you expect extreme level of industry level change. If you respond at 1, you expect virtually 0, no industry change at all. So the first idea here is, all right, how do you see your industry changing? Now, if you do this with these guys, you will get a very different response. So step 1 here is really trying to agree on what is our outlook on the future. How much or how little change do we expect to see? Then question number 2 is this concept of market opportunity. How good are we as a company in identifying emerging opportunities, meaning market segments or market pockets or large market needs that is not fully developed. The market today for autonomous cars is not very large. If you do market sizing today, you're going to have fairly low numbers. But of course, looking 5 to 10 years ahead, the market for autonomous cars might become very, very large. So that's understanding market opportunities. Now, in this example, we gave that a 2, which is very, very low. So what we have here, by giving a 7 to the industry shift outlook, is we expect fairly large change. But we as a company, we're pretty bad at spotting new market opportunities. So this would be a very challenging opening right here. Then we get into resource allocation. Question number 3. Resource allocation is, all right, let's say we have a big pie of innovation resources, people, time, funding, management attention, board attention. How do we want to distribute those resources? How much of our resources should go into developing the existing core business? So producing more cars better. How much should go into developing new areas that's fairly close to our existing core business? Making better cars, making better supply chains, making better dealership partnerships, adding on aftermarket services, car insurance, selling more baby seats for the car user, really add on close to the core business. And then resource allocation number 3, how much resources do we allocate to exploring new growth areas and entirely new business models? So in this example, we said, okay, this traditional car manufacturer, they want to allocate 75% to their core business, 20% to adjacent businesses, and about 5% looking into growth and new business models, which of course is a very low number. It's a very traditional distribution, and it also makes for a very challenging innovation strategy. Now, in real life, working with clients and executives on this, we feel that these first 3 questions that we just addressed, the industry shift, the market opportunity, resource allocation, those are very, very important to get early, get agreement, get understanding, and get those on the tool or on the wall. All right. So then we move on, and now you probably recognize we have the build, buy, partner, co-invest, co-develop. So we work with the client to explain what this means as a basic principle, and then we say, how do you prioritize these? What's most important to you moving forward? So in this case, again, very traditional, we said that, all right, our most important part of our innovation strategy is we'll build it ourselves. We'll use our engineers, we'll use the talent we have today, We might hire a few new people, but we have a very closed innovation logic. We'll do this ourselves. Number two, second priority, is if we can't do it ourselves, we'll just go and buy someone else, maybe in our own home market or overseas. Priority number three, okay, we can probably find some partnerships. Maybe if you're a traditional car manufacturer today, you want to partner with IBM, you want to partner with Cisco, you want to partner with Tencent, you want to partner with Alibaba. So these are likely and also unlikely partnerships. Now notice that we put, for priorities number 4 and 5, we really put question marks. We find in our experience that a lot of large companies, they simply don't have the language or the understanding for co-investing in portfolios of startups or co-developing accelerator programs. Now, of course, these are skills that you can develop fairly easily. But as a starting point in this example, we have a very traditional company. Priority number 1, we'll build it ourselves. Priority number 2, we'll buy something. And priority number 3, we'll go out and partner. But that's a low number 3. Co-investments, co-development, it's not really even on the priority as a field. Taking the next step, we go into, okay, so what do we actually do? So now we're going more into the build side. It's ranked as our number 1 priority. So the key program that we have in place, which most large companies would have in place, that we put in for this case study is, well, we have an internal innovation team. These guys can handle this. Our internal innovation team might be led by VP of technology. It might be led by executive VP of business development. It might even be led by the innovation director. But we have our own team, and they can figure out this market opportunity around autonomous cars and smart cities and connected societies. Our biggest need, which is moving down the tool here, is really, okay, well, what does this team need? Well, in this case, they need to understand technology, because if they've been focused on building cars, they need to understand the technology that's emerging around autonomous cars, smart cities. Key capability we should develop. So now we're moving down on the build side. We need to develop capabilities around software development, software application, developing apps, both for internally in the car, but also to the user smartphone or the user platforms. But also, and very importantly, we need to develop skills around new business models. Because in this example, autonomous cars will most likely have very different business models than the traditional sell your car and park it. Autonomous cars will have potentially quite disruptive business models, and this would be a capability the innovation team should develop. Now, traditionally, and you might see this already in, okay, well, what is our next step? Well, we go out and we hire more engineers. So this build example that we have on the screen now is a fairly traditional, some of you probably recognize it, in building the internally focused innovation capabilities. Moving on to the next one, the buy side. All right, well, the key program that we already have in place in this example is an M&A team. We have a merger and acquisition strategy team. It might be just one person. It might be half a position. It might be a team of 3 to 5 people. The biggest need that they have is acquiring technology companies. The key capabilities that they should develop is spotting new companies, spotting new acquisition targets, and really get access to deal flow early. Some of you, if you follow this space, know that traditional car companies, they're maybe not the fastest moving, but right now in the acquisition space, they're coming up against the likes of Google / Waymo, of Tesla, of NIO, of Tencent. which are all, of course, technology-driven companies that move much, much, much faster, higher valuation, more aggressive funding. So the capability on an M&A team would be getting access to the deal flow faster. So what are our next action? Well, get out of the building could be an example of an action, and simply be more externally focused. Connect to some of these emerging communities, connect to some of these emerging ecosystems that the traditional car manufacturer normally wouldn't have access to. Now, this would be an example of course, you could change this depending on your own need, but this would be an example of how to apply the buy side. Moving on, we get to the partner side. Now notice here when we go down on the partner side that we said, well, what is the key program that we have in place? Well, actually it's none. We don't even have a program. Of course, we have some partnerships here and there, they're floating around, but there's no strategic framework. There's no strong partner program in place. Now, I mentioned Cisco earlier, and Cisco, of course, is one of the leading companies in the world in strategic collaboration with partners. Cisco get more than 80% of their revenue coming through the partner channel, and they have developed zealously or religiously a focus on building partner success. So Cisco would have really strong programs in place. For this example, going down on the partner side, there's no programs in place. Our biggest need, well, develop new strategic partnerships. Key capabilities, we need to identify new fields of expertise, meaning what kind of partners do we actually need? And next action, well, go out and meet likely and unlikely partners. Fairly straightforward, but in my experience, also quite, even this is quite challenging for established companies. Then we have co-investments. Co-investments in this example, we don't really have it as a priority. We have no program in place. Our need, very basic, is to understand startups, understand venture, and understand investing. Key capabilities we should develop. We need an internal venture team, and we need to access internal funding mechanisms, ideally set up our own company venture fund for co-investing in new startups. More and more companies are now improving their corporate venture capital arm, but it's still fairly early. Research from BCG shows that about 37% of all large companies have a strong corporate venture capital program in place, but the majority still don't. So what's the next action? Well, we need basic learning, and probably the most important person is to get the CFO to understand the basic principles, the risk, and of course the mechanisms for how and maybe even why we should set up a fund. So that's the co-investment. And the last one is the co-development. So that is, how can this traditional car manufacturer build accelerator programs on a global scale? Well, key program in place today, none. Our biggest need, well, we need to understand accelerators and what this even is. Key capabilities that we should develop, well, we need a team in place, internal team, and we need to understand how accelerators actually work. So the first action here is basic learning for the strategy team and also maybe parts of the management team. Now, if we pull all this together, you have here a framework for building a minimum innovation strategy. We have pulled together different perspectives and sources into one, and it's important for us to say, into one fairly simple tool, but it has a lot of complexity once you start adding to it. I would just like to take one or two questions and see if we can get some comments. How does this, what I've just shown you, this example and this tool, how does this relate to the innovation strategy that you guys have in your companies? Does this make sense? Do you see any big gaps that we have missed? Do you see anything here that would be very relevant for you to bring back to your own company? Is this logic easy to follow? I mean, is it a good flow when we describe it this way? Just any kind of quick comment or input before we go to the next case. Feel free to fire away on the chat box, people. All right, so we have the first overview from Torben. It's a good overview. Thank you. I'm glad to hear. Normally, we would introduce this using statties and pens, so I'm glad it comes through in this setup. We have a comment from Prab, logic and quite lucid. Thank you. But it does call for new skill sets into the company, like VC skills, partnership skills, etc. Yes, I mean that is a perfect example. Perfect example. This requires capability building. It requires building new skills, learning new skills within the company. Companies that traditionally have been very internally focused find, especially item number 3, 4, and 5, so as a partner, co-invest, and co-develop, find this incredibly challenging. We've seen large companies, Statoil being one example, really develop these skills over about a year and a half. We've seen smaller companies develop these skills much faster. But like you're saying here, Prab, they need to develop VC skills here. We have an interesting tool, great. And we have Jamie, this makes sense, we're at the partner stage currently. A lot of companies find the partner stage fairly easily. Then we're looking to move into the co-investment and co-develop. So again, what Jamie is saying here is kind of the trajectory we see a lot of companies on. Then we have a question on how to apply this to the public sector. I replied this fairly briefly last time, but we believe this is equally applicable to public sector, depending on sort of the market opportunity you follow. But I'm going to try to come back to that a little bit later. We have several people here on the public sector. I'm going to do one more question before we move to the next case. How do you source market opportunity? That is a very important question, very good question from Florian. You need external orientation. A lot of companies that are very preoccupied with operational efficiency, operational issues, cost-cutting savings, they develop, as many of you probably know, a very strong internal focus, and they miss opportunities. You need someone with a curiosity or a focus out of the organization. This might be the CEO, ideally. It might be the strategy officer, ideally. Or it might be different leaders at different levels. Market surveys, that's one. But market surveys doesn't really get you to market opportunities. Market surveys are usually the existing customers on the existing products. We have other tools in our toolkit that you can find on strategy tools. That allows you to map out some of these market opportunities. We look at trends, we look at technologies, we look at unmet customer needs, and we look at our internal ideas. But I think it's important for the market opportunity to be curious about emerging trends, technologies, and customer needs, and try to understand these not as technology threats, but as our market opportunities. We have a question from Licia on the resources. I'm going to try to bring that back later. Jillian, can you help me remember to come back to the question on the financials and resources? And then we have Heike. I'm going to try to come back to that question as well on how all these priorities connect, because if you do this the way that we normally would, I mean, again, you have the tool, and we sometimes blow this up to 2 meters by 1.5, or 1 meter by 1.5. So it's a large group tool. And we have, I'm going to see if you can see this, basically people working on the tool, discussing and brainstorming together. That's where we get a good discussion on these different priorities and connections. Make it a social process, not just one person sitting and doing it by himself. But I want to thank you guys, all of you, for some really good questions and comments here, and we'll stay on and answer more of them afterwards. But I'm going to move on to the next case. And as I move into this one, feel free to ask any questions along the way. So our next case is a seafood startup. And maybe, Jamie, I don't know, but maybe this will be even more relevant to the work that you're doing. It's a young company in this case. It's a company that's it's less than a year old, and it has a fairly young team. So very different dynamics, very different skills, and of course, very different culture from the corporate example that I showed you a minute ago. So in this case, we're saying, okay, we're taking premium seafood to China, connected with a digital business model. So the market opportunity here is in China, high-end premium seafood. That's the market opportunity. So in this example, this is a company I'm familiar with. They see an industry that's changing quite rapidly. Consumer trends, mobile technologies, Alibaba's new retail strategy, a changing shift towards more healthy living and food safety. So from where they are sitting, they're seeing an industry that's really changing a lot. So they see a market opportunity that is massive. It's a massive multi-billion-dollar market opportunity if you can just tap into it. Now, interestingly, even though, or maybe because they are a startup, they also know that they need to innovate faster. So they have allocated much more of their resources into new innovation rather than just improving the existing core. So in this example, we can actually say that about if you take all of the available innovation resources, time, people, money, 40% go into growing the existing first products and services, 30% going into new products and services, but 30% go into entirely new business models and growth area. This would be very challenging for most large organizations, but it's more available. It's more possible for smaller companies, moving very fast, being very agile. Now, in this example, priority number one is okay, our primary innovation strategy is driven by we'll build this ourselves. Merger and acquisitions, we don't really have money for that, so that's not a priority at the moment. Partners, very high priority. Co-investments, and then co-development. So notice that build, partner are the two strongest ones, but co-developing and co-investing comes quite close at number 3 and 4. So the key program they have in place is, of course, the founding team and the core team. The biggest need that they have right now in this example is they need to grow their sales team and they need to develop their technology platform. So it's not so much about the product of seafood, it's about the go-to-market strategy and the technology strategy. And of course, this changes. A month from now, 2 months from now, 6 months from now, the innovation needs of this company will change quite naturally. The key capability that they need to develop is business development. And the next sort of immediate next step action is we need to hire our sales team. Now, many startups would stop here and say, that's enough. We need to focus internally. We need to build our team. We need to build our skills. We need to bring in salespeople and business development, and then we'll grow this organically. Not in this case, though. So this case study is extremely good at working with outside innovation. So the very high priority for them is to develop strategic partnerships, identifying all along the value chain, both at the Norwegian end, the UK end, the US end, and on the Chinese end, who are potential, likely, and unlikely strategic partners. They're very focused on what do we need from our partner. And again, notice it's market access and technology. So the underlying needs here are similar to the build side, but they're trying to work more aligned with partners to do this rather than hire and build everything themselves. A capability that they should develop that they don't have in place is a strategic partner framework. Basically a template. How do we work with partners across all partners? How do we make partnerships successful? And how do we make our partners more profitable? So that's a capability that they should develop, but it's not developed at the time. Current short-term action, we need to go out and meet more potential partners, more likely partners, more unlikely partners, and also really cement or establish stronger relationships with the partners that we have. Now, some startups do this naturally. Some startups wouldn't do this at all because they're so focused internally. But I believe that any company, big or small, having a strong, clear partner strategy is incredibly important. But so is also the next ones. So in this case, we have co-investments. And this is fascinating. Should a startup less than a year old do investments in other startups? Now, most people and most of the literature would say, of course not. They have a hard enough time raising money themselves, which partially is true. But we've also seen some very interesting things happening when small, agile, aggressive startups invest in strategic partnerships and invest in other startups. They build a much stronger go-to-market offering than they would by themselves. So in this case, they don't have any investment program in place. They don't really have an investment strategy in place. They need to identify early strategic startups. They need to develop an investment strategy. And the first action is really, let's develop a one-page, very simple, very short investment strategy for investing in new startups that can be a good match to us. Then we have the concept of accelerators. Now, in this case, taking premium seafood to China, accelerators can really be used as excellent go-to-market channels and go-to-market partners. It's not common, but in this case, for this example, accelerators from foreign markets into China is a perfect match. And again, the underlying need is access to technology and access to market. And many accelerator programs are really good at that. The key capability we should develop, not really something that we need. And right now, the first steps is just let's identify potential accelerator programs. Let's throw in some applications and let's just jump on it. This setup is different. Now, in the corporate case on mobility, it's a large organization, many moving pieces, and a culture that very often kind of focuses internally. In this case, I think we are showing that it's equally applicable for very young companies or very early companies to develop complex yet minimum innovation strategies. So I hope that has been interesting to you. I believe that the minimum innovation strategy tool is easy to grasp, simple to understand. But once you start working on it, ideally with your team or with your board, it uncovers fairly complicated issues, and it helps build a simpler, but also a clear or more clear innovation strategy for your company moving forward. You can find the tool. You can find the how-to guidebook, and you'll find more resources online on strategytools.io. So you can download everything there. Now we have a few minutes left. I'll be very happy to take any questions, any comments. I'm gonna try to make sure everyone get addressed, and we can also go a few minutes over time to make sure that we get everything answered. So let's see. We have a question here from Farid Singh. The webinar misses the why for innovation. A vehicle for innovation driven by the intent. No, this is good. The why innovation is, of course, critical, absolutely. And it connects back to the overall company strategy. And probably like you, Farid, we find a lot of places, senior executives are not really able to answer the why. I didn't cover it in these cases, but I'll be happy to touch on it. So in the example of the corporate, the mobility, the manufacturer, the why innovation would very likely be fear driven, meaning we have a lot of resources invested in our manufacturing process. We have a lot of resources invested in our traditional way of doing business. And we see this autonomous trend coming. So if we don't do anything, we will get left behind. So that would be, well, the why would be driven by the fear of missing out. And of course, the very real risk of becoming disrupted. Now, the second example, the seafood startup, the why of innovation is really successful go-to-market. How can we succeed faster? Why do we need innovation? Well, we need innovation to get from our product to market as fast, as smart, and as agile as possible. So the why is much more positive driven. It's much more energetic. It's much more leaning in on the, I'd call it, constructive side. So that's, in those two examples, the big why. So good. Farid is giving us some follow-up comments here. Great, the fear, yes. And once fear is identified, they can determine how much they want to spend on it and then want to see impact. Once at hand, they can determine whether to build the best. No, I'm happy to clarify. I think fear and loathing, well, it's a misunderstanding. Fear and understanding is a big part of where many companies are right now. What happens if we don't do anything? And especially, and this is why I use the mobility case, the landscape is shifting so fast that the big companies like Volkswagen, BMW, Volvo, Toyota, they have so much resources and so much assets sunk in their existing business model, but they all see a market shifting towards significantly reduced sales of new cars, a significant uptake of mobility as a service, the Uber and the Grab, and they don't really have their place in this new ecosystem. So the fear is creeping in, but then really getting from fear to understanding is a big shift. I think many of those companies are going through now. We have a question from Hike. How does competitive advantage of a company get accounted for in determining all these different priorities? That's a good question. So if you're familiar with the work of Rita McGrath, we share her thinking in terms of competitive advantages becoming much shorter, much tougher to maintain, and much less sustainable over time. So our starting point is that any competitive advantage you have is going to be very short-lived, and it's not really going to be sustainable for the long time. And that pushes you, in our world, and also what we've seen with clients, that pushes you towards a more open and faster innovation. So it pushes you from defending a traditional competitive advantage here. It pushes you toward innovating faster across the ecosystem this way. And we have a question from Pablo. I believe innovation could be driven internally, yeah, but must be a separated team. I do not believe at the beginning to make all of our company innovative with innovation coming from everywhere. That is fine. We need someone, person or team, focus on making that happen. What do you think? Now, Pablo, I totally agree with you. I think the idea of everyone should innovate all the time is maybe it's a hoax. At least it's extremely wishful thinking. It is extremely important to separate the various focuses. And I'm going to sketch this out really quickly. So we have a tool that we call strategy intro, and you have three different innovation systems. Very simple. So for most companies, any innovation within the core area here will be small, careful, and quite sustaining. Any innovation in the growth area is probably going to be more opportunistic, but fairly safe. But it's really in this explore phase that you're going to have really radical innovation. And you need to organize these, of course. So very, very quickly sketched out, you're probably going to have three different people responsible for three very different innovation activity and strategies. You can get ideas from everyone, you can get support from everyone, but I don't really buy into the notion of everyone should be innovating all the time. It is a balance. Then we have Martin. Innovation is the new competitive advantage for any organization. To a very large degree, I would agree. Farid Singh is, he mentioned that every solution has an HR element to it. And considering the audience we have, can you have a... No, I agree. Farid, we believe that innovation really is a social process. It requires us to get the right people in the room, discuss and collaborate. You need to have facilitation skills and you need to have people skills. You can't do this as a clinical analytical exercise. So I would agree that there's a large element of HR, creating engagement, creating buy-in, creating understanding. Question from Torben. The best types to have in an innovation session, all or selected few? Good question. So I suggest bringing different sections from across the organization. So you want to have somebody from senior management, you want to have somebody from business development, you want to have somebody from technology. It's a luxury if you have a regular innovation team. Very few companies do. But really get a cross-section from across the organization. And we have a question from Hike. When or at which stage shall the organization think of having an innovation strategy? Well, Hike, that's a good question. I think every company at every stage, whether you're a startup, a scale-up, a growth company, or a large established company, should have a very clear innovation strategy. But it will change. If you're a startup, your innovation strategy might change every single month, maybe even every single week. If you're a large company, you can probably map out an innovation strategy that lasts for 3 to 5 years. So I think every company needs it, but it will be very different depending on which stage you're at. If you go to strategy tools, we have a tool called the growth map. And the growth map explains exactly how an innovation strategy could be different at the various stages of a company life cycle. We have a question from Prab. The startup strategy to invest in other startups is an unexpected eye-opener. Brilliant. If one just ponders on it a bit. Well, I'm glad you feel that way. I'm glad you feel that way. it's not common. It's not in the textbooks. It's not something you see a lot, but it's something that we've been exploring and we've done in a few cases ourselves. And as long as you handle the financial side, I think it's a smart move to do. Farid has a smile here on the good HR. All right, we are just about to wrap up. I'm going to cover the question that we had. So the question that we got earlier that I didn't get to answer was, how do you add onto financials, resources, and result as perspectives? That is a really good question. It's a question that really deserves more time, but you can, and you do have the freedom to experiment on this. And we're experimenting and developing all the time. So what we can put on is, I'm not even sure if you can read this. So I just put on expected result and expected outcome. Sorry, budget. This would quickly give you the opportunity of adding the financial resources and also the, well, either ROI, return on investment, or simply just targets for this track. So this is something that we'll be thinking about, should we expand the tool by adding those two? That's a great question. And it makes perfect sense to keep adding that as you go. Then we have the question of public companies and public organization. And again, in this webinar, our focus is really on market-driven organizations, right? I believe that this tool can be equally applicable to a government agency, a municipality, a non-profit organization. It requires a little bit of adaptation, but I think that can be done fairly quickly. So what I'm going to do is I'm going to take it upon me and Jillian to come up with a public innovation framework built on this. So if you stay with us for a few weeks, we'll put some work into this and see how we can adapt this framework even better to a public organization, whether that's public companies, government agencies, non-profit organization. We'll dig into that because it's a good question. All right, so we have Florian asking, how often do you suggest to update this innovation portfolio framework? By what teams? Florian, it all depends. If you're in a very fast-moving environment, you could actually do this every single week. If you're in a much more stable environment, you could probably do this every 2 or 3 years. But we are seeing companies doing this faster and faster, more frequently. So I don't know which type of company you're with, but probably faster and more frequently than you would have been doing traditionally. Then we're going to do the very last question here by Martin in the Q&A box. Innovation and operation are different and separate. Companies need to get better at both. Both better at operation and also better at innovation. This is true, Martin, and I fully agree. And that kind of goes back to, I'm not sure if you can see this, but it goes back to this area. So here you would say that the core business is very much about operational excellence, cost-cutting efficiency, improving Lean Six Sigma. As you move along here, you get more of what's frequently called the dual transformation or the ambidextrous organizations, where you really start looking into more sustaining innovation or enabling innovation, and then the really radical new stuff, entirely new business models. And it should be different business units. It should be different people. It should be different cultures in these different areas. But that's a topic for another webinar. My name is Chris. We have Jillian helping out in the back here. I really hope this has been helpful. Thank you for tuning in. Thank you for staying over time. We're about 10 minutes over time, and I appreciate that. So I wish you all a very good afternoon, wherever you might be in the world. We'd be very happy to take any questions, comments, feedback by email or any other social media channel. And I'll be very happy to connect on LinkedIn or in any kind of way. If we can help, let us know. Have a great, great day, all of you. Goodbye.